Each crisis is more dangerous than the one before. So 1998, 2008, we're going to get to a point, we may be there, where the crisis is actually bigger than the Fed, bigger than the Fed's ability to stop. We are uncomfortably close. Now, it's impossible to know exactly how close because it's a complex dynamic system. And you can make very good predictions on complex dynamic systems as to the magnitude of the crisis, but it's very hard to get the exact timing. But I can say that we're uncomfortable because now we've been there twice before in recent years. 1998, we came within hours of shutting every market in the world. It began with a Russian default, by the way. August 17th, 1998, Russia defaulted on their external debt and the ruble was grossly devalued. That started a global liquidity crisis, went around the world, ended up in my lap at Long-Term Capital Management, where we had $1.4 trillion of derivatives. And everyone goes, oh, long-term capital, you guys lost a lot of money in Russia. We didn't. We lost maybe $100 million in Russia, but we lost closer to $4 billion on everything else, because in a liquidity crisis, people sell everything. It's not a question of, do you have Russian bonds? It's like, no, they sell everything. Spreads widen, not enough collateral, margin calls, people being blown out of their positions. That's what a global financial crisis looks like. We cured that with a $4 billion all-cash injection sponsored by the Federal Reserve and 2 rate cuts, one on an emergency basis by Alan Greenspan. We got through that, but we came within hours of shutting every market in the world. Same thing in 2008. We all know, September 15, 2008, Lehman Brothers. Okay. People don't realize that, Morgan Stanley was days away from failing. Goldman Sachs was days away from failing. John Mack said so at the time. He said, Lehman was begging for help. He said, sorry, I got enough on my plate. We're worried about Morgan Stanley right now. And then the Fed came in. And so think of it as dominoes are falling. So all the dominoes are falling and they're going to keep falling unless you truncate it, drop a wall in. And that wall was the Fed. But here's my point. Each bailout gets bigger than the one before. Each crisis is more dangerous than the one before. You want assets that are going to be immune from a global liquidity crisis. What are they? Land, real estate, gold, silver, fine art. I see Andy Warhol, Marilyn Monroe has gone, they estimate $200 million. You could have bought that for $50,000 in the 1970s. That's a little more specialized, but there are, natural resources, water, et cetera, energy, oil. If you want to be in stocks, okay, get stocks of companies that are based on natural resources, such as ExxonMobil, Chevron. I'm just giving these as an example. But there are a lot of ways to protect yourself. But, a regular stock portfolio is not a good one. And, banks are going to be in distress. Money market funds are going to be in distress. That's what a liquidity crisis is. I point out that the dollar has been a cryptocurrency since at least 1979. That was the last year the Treasury issued a paper treasury note, like you had a note. Maybe somebody's grandmother still has an old one in the attic, but they had little almost like stamps, like you peel off a coupon and take it down the bank and get paid. The last time they did that was 1979. So the dollar has been digital and message traffic has been encrypted since around 1980. But I think in terms of the impact on the dollar, this is, be careful what you wish for. And this was exactly what I was saying earlier in terms of second and third order effects. And I warned the Pentagon about this and I warned the Treasury about this because I know how economic sanctions work. I've been very involved in that from the point of view of the intelligence community and also advising the government, but they can be powerful. But if you use them too much and too broadly, they actually lose all their impact because the people you're targeting say, well, okay, no mas, I'm out of the dollar system. You've done it one too many times. And this is an example of that. We've never frozen a central bank before. We have now. We've never kicked an entire country out of SWIFT with the exception of Iran, but that's a much more isolated case. We have now with Russia. And so instead of just sitting there saying, oh, gee, you got me, we can say, okay, let's go to a new payment system. Let's pick up a new currency. The Saudis are saying the same thing. And all of a sudden, if you're one of the top princes of Saudi Arabia, maybe Mohammed bin Salman or any of the top princes, you have a yacht in Monaco. You have a house in Aspen. You have who knows how many houses and palaces and yachts around the world, private jets. And they're like, hey, actually, all that stuff could be seized because that's what we're doing to the Russian oligarchs. And by the way, it's not limited to oligarchs. We saw this kind of neo-fascism in Canada very recently with Chrystia Freeland, who's the deputy prime minister, freezing the bank accounts and the crypto wallets of the truckers. Canada went so far as to criminalize it. If you supported the truckers under a recent interpretation of Canadian law through Chrystia Freeland, the deputy prime minister, that's a criminal act. So I told Justin, I said, come and get me. But my point being, so she's seizing the accounts of blue collar truck drivers and Biden's seizing the accounts of oligarchs, but it's the same thing. Okay, blue collar, multi-billionaire, but it's the same thing. Suddenly, Canada and the U.S., two of the number one, I think number 5 economy in the world, number 6 maybe, have frozen Canadian dollar and U.S. dollar accounts of people they don't like. Now, you can say it's for good reason, and Putin should have invaded Ukraine. I get it, but if you're a Saudi prince, if you're certainly a Russian, if you're a Chinese oligarch, how comfortable are you with the dollar right now? I haven't met him personally, by the way, but I checked him out. Looks like a thoroughly bright guy. But other than carrying Larry Fink's briefcase for a few months, I mean, he's a year maybe, he's never had a job outside of academia or government. So he doesn't really understand the real world and doesn't understand what we're discussing right now. So the answer to the question was that they didn't think this through. They don't understand these knock-on effects. They don't understand how the international monetary system actually works. They don't understand the blowback. I mean, I'll give you another example. This one has received some publicity. So we throw all kinds of sanctions on Russia. So Russia said, okay, we're going to stop Russian exports of strategic metals and chemicals and other elements that everyone else needs for inputs in their manufacturing processes. And they put a ban on exports of nickel. Well, okay, so you need nickel to make batteries, so good luck with your electric vehicles. But, okay, so U.S. throws sanctions on Russia. Russia retaliates by banning nickel exports. The price of nickel goes to the moon. It went up by a factor of 4 or 5. That's really not surprising. London Metal Exchange fell down. They had to close. Yeah. Okay, but who lost? There was a Chinese billionaire who owns one of the largest nickel mining operations in the world, who lost, I think, $5 or $6 billion. So here's Russia and the U.S. fighting an economic war, and the loser pops up in China. That wasn't on his radar screen, and that wasn't on anybody else's radar screen. But it's a good example where the damage shows up when you don't expect it. Russia had about 600 tons of gold, and today they have 2,300 tons. China had about 600 tons of gold, and today they have about 2,000 tons, just slightly less, that we know of. And they may have several thousand tons off the books in the State Administration of Foreign Exchange that we don't know about, because that's completely opaque. So Russia and China did exactly what we warned the Pentagon about in 2009, exactly, which is increase their gold reserves by a factor of 4 or more. But everyone's like, well, the Chinese yuan is going to be the global reserve currency. No, it's not going to be the ruble. But here's why. Well, there are a lot of reasons, but the main reason is when you talk about reserve currency, you have to understand what that means. It's not like the People's Bank of China has a bunch of $100 bills on pallets stacked up in the basement. When people say reserve currency, what they really mean is the currency of the bonds that they invest in. In other words, they're dollar-denominated assets in the form of treasury bonds or notes. That's what China actually has on their books, not like the dollars per se. So if you want to suggest or hypothesize that the Chinese yuan is going to replace the US dollar as a global reserve currency, where's the yuan bond market? I mean, it doesn't exist. Very small scale, very illiquid, no primary dealers, no win issue trading, no auctions, no repo, no settlement clearance, none of the plumbing and the mechanics of a mature bond market such as the United States. And above all, they don't have a rule of law. I mean, at least if somebody reneges on a treasury bond, you can sue somebody, but you can't do that in China. So the absence of the rule of law, number one, the absence of the infrastructure, the plumbing, for want of a better word, are two reasons why the yuan and certainly the ruble will not replace the dollar as a reserve currency. However, what I was hypothesizing then, and I would come back to this, is you can create a brand new currency that does have all that stuff. And in my example, they used a Swiss bank, UK law, put the gold in a third-party depository. If you wanted some of the new currency, you could deposit your own gold and get some of the currency or trade with them or run a surplus. So it was a replacement system, but you would need the gold to instill confidence. But they don't have bond markets, so they're not going to have them soon. So the yuan and the ruble aren't going to replace anything. There's good reason to believe that we are looking at a potential collapse of confidence in the US dollar and indeed the entire international monetary system. The international monetary system is based on the dollar, so if the dollar goes, the system goes. That's not meant to be a provocative statement. The international monetary system has actually collapsed 3 times in the past 100 years, in 1914, 1939, and 1971. So this would be the 4th collapse in 100 years, so not that infrequent. And when the monetary system collapses, it's not the end of the world. We don't all go live in caves who do canned goods and all that. What happens is the major trading and financial powers get together, they sit down, and they recut the deal, what's called the rules of the game. So what I want to think about a little bit is, since we can see the collapse coming, is what are the new rules of the game? What would the international monetary system of the future look like as a result of a sort of a new Bretton Woods style conference in the face of a collapse? And I've got 4 scenarios here: multiple reserve currencies, SDRs, gold, and collapse, followed by something worse. Multiple reserve currencies, the idea is, in 2000, 70% of international reserves were held in dollars. Today, that number is 60%. It's trending down. So imagine a world where the dollar goes below 50%. Maybe it's 45 or 40%. The euro comes up. The Australian dollar and Canadian dollar were just recently admitted by the IMF as official reserve currencies, so they have a larger role. And we end up in the situation where, you got a whole bunch of reserve currencies. I call it the kumbaya solution. We all just get along. This won't work. This is unstable because there is no anchor. There's no gold. There's no dollar. So instead of one central bank behaving badly, you'd have 5 or 6 or 7 behaving badly. I think this would exacerbate rather than mitigate the currency wars. The next one, this is the one preferred by the elites. When I say elites, it's not a deep, dark conspiracy. Finance ministers, treasury secretaries, academics, central bankers, other policymakers. This is the SDR. The SDR is a special drawing right. It's understood by very few people, but it's unbelievably simple. The way to understand it, the Fed has a printing press. They can print dollars. The European Central Bank has a printing press. They can print euros. And the IMF has a printing press. They can print SDRs. And that's all it is. It's world money. They can print as much as they want. They hand it out. They can reflate and reliquefy the global economy. The IMF actually has a 10-year plan to make the SDR the global reserve currency. Again, not a secret. You can find it on their website. I want to give a quick example because I know this is attuned to policy, but how the SDR is already sort of creeping into our system. The United States Treasury got authority to provide $100 billion to the IMF. This was legislation passed in 2009. So what did the IMF do with the money? Well, what they did is they, if you look at the total IMF loans, credit lines, etc., 91% of all the IMF loans and advances, they went to bail out Europe or to Mexico. Only 9% went to the rest of the world. I leave it to you to decide whether the president was entirely candid with the Congress when he said this is primarily for developing and emerging market economies. You don't see Korea, Indonesia, India, Brazil, Thailand, Malaysia. You don't see those countries getting more than 9% of the IMF money. This money basically went to bail out Europe. So that's another thing where, again, I think the American people were a little more aware. They might raise a few questions. Third outcome is the gold standard. I'm just going to go through this very quickly. All gold standards are a relation between paper money and gold. But you have to ask yourself a couple questions when you set up a gold standard. First one is, what's your definition of money? Because we have M0, M1, M2. These are technical definitions. They're all different. So you have to pick one of those to be your money. The second one is, what's the proper reserve ratio?